In this episode, Ryan and I discuss several talking points that are prevalent in the big wide world when it comes to life insurance and the infinite banking concept. But we begin today talking specifically about universal life. We had fun, and I hope you do too. Thanks for listening. All right, welcome to the Banking with Life podcast. My name is James Neathery. I'm your host.
And I'm Ryan Griggs, your co-host.
We're happy to be here, having fun. Hope you have fun as well. And
when did we start this podcast?
I don't know.
It's been like a few months.
Been several months.
Yeah. Last year even. Anyway, point I ask is like today. Point of today's episode. We go through the months and you hear kind of typical objections. People have a lot of the same questions about the infinite banking concept and becoming your own banker. And so today we wanted to sort of list those out, just name them, put them on the table, be like, if you have these objections, we get it, we hear you. A lot of other people share the same objections, and then maybe over time, throughout the course of a series, we'll go more in depth on each one.
Well, I think that this is more than a list of objections. Okay, I think that, and we listed out a couple of topics. Yeah. And really these topics, yes, they can be objections, there's no question, but I see this list of topics as like talking points that live out in the big wide world.
Talking points, that's good.
They are, and that lack clarity. Mm-hmm. So there's, in my opinion, a great lack of clarity on these talking points that we're going to go through today. So we're just going to cover the big broad list that we just put together like 5 seconds before the camera was turned on. But then as we go forward, we're going to do a podcast that really goes deeper into each of the topics, talking points that I'm telling you lack clarity out in the big wide world. And before you put money, whoever you are, before you put your money into life insurance, you should have clarity on these topics. Okay. And, we're just trying to do our part to bring clarity.
Yeah.
So,
all right. So let's list them. So let's see. How many do we get? 1, 2, 3, 4, 5, 6, 7, 8. All right. So I have 8.
You have 8.
Yeah. You have 8?
I have 7.
Okay. Close enough.
Well, somewhere between 7 and 12 by the time we finished.
All right. So the first one is, can I do infinite banking? Can I become my own banker with universal life or other versions of universal life? Variable universal life, index universal life, equity indexed universal life. All right, so can I use that? Can I use some version of UL instead of ordinary dividend paying whole life to become my own banker? Second, should I be worried, or how should I think about direct versus non-direct recognition? Right, so the recognition policy that mutual life insurance companies have. Should I buy a policy that practices direct recognition, a policy from a company that practices non-direct recognition, and for those companies that offer you the choice, should I choose the direct approach or the non-direct approach? So there's some of that out there. Then the next one, big versus small. Does it matter?
The big companies.
Do I need to pick the brand name?
Big 4.
Yeah, big 4, big 5, big 6, however many big there are now.
Okay.
So size, and then 4, the idea of debt repayment and it sort of cheapens the concept, I think, sometimes when people pigeonhole infinite banking, IBC, becoming your own banker as solely a method to get out of debt. Although it can be used for that purpose.
Yeah, and that's just one of the sales methods or programs or whatever you want to call it to present this idea of becoming your own banker is how to get out of debt.
Yeah.
Right. Yeah. So, and there are other sales methods or
really it's infinite banking repackaged.
Or
an attempt to repackage.
Repackaged, yeah. Like twisted, contorted.
Okay, so that's
skated.
Yeah. All right, so number 5, the subject of dividends. Where they come from, why they matter.
That's a very broad subject. The games that insurance companies play with dividends and the games that they played for 200 years with their dividend scales.
How it relates to illustrations, the illustrated values. Yeah. All right, so the subject of dividends. And then, oh my gosh, I have to pay interest on a policy loan.
What? They're going to charge me interest to borrow my own money?
Yeah.
What?
So interest on policy loans. Then the subject of stock versus mutual companies. So the organizational status, the legal status of the company providing the life insurance policies. Are they owned by shareholders? Or are they owned by the policy owners? And then I think the number 8 for me, I had 8, you had 7. I added the internal rate of return. What's the growth rate?
Yeah. No, I had that one. I didn't have the get out of debt. Get out of debt.
Oh, okay.
Right. Let's create a big old 10-page Excel spreadsheet and prove the wonders of the infinite banking concept by putting all your credit cards and your debts and your first, second, third, fourth, fifth policy up there. And and then hiring all the staff and paying all the consultants to run those Excel spreadsheets. And
it really falls under like a show me the numbers illustrations kind of thing, the marketing games that are out there.
All right, so let's just go back to UL. My numbering is completely out of order. Yeah,
that's all right.
But you originally said, "Can I bank with Universal Life?" Right, and I want to say that by gosh, you can bank with anything. You've said it many times. You can bank with farm equipment, margin account, CDs, cash, whiskey, tobacco.
Yeah.
You can bank with anything because banking is a process. It's not a product. The banking is just a movement of money. Loans, loan repayments, deposits, withdrawals. It's just a movement of money. But whomever is performing that banking function in your life is profiting. Okay, so the short answer is yes, you can bank with Universal Life. What's the problem? I mean, why are you picking on the products?
And there's all sorts of new ones, right? The very many different I like your word, talking points around those products, right? So the premium is flexible, right? The whole Universal Life product suite is supposed to be more flexible. You can change the death benefit, you can change the premium, you can change when you pay the premium, right? It's supposed to be the more attractive feature relative to whole life, which is supposed to be more rigid and unfair,
stodgy, dusty, and old. Oh my gosh! What did Greenspan call the gold, standard after 66 when he 1966 I believe he wrote the article. It's like, it's the greatest thing ever, the gold standard. But then he comes off of it in the 90s. He referenced the gold standard as like very archaic, or you know what I'm talking about?
I don't know the exact quote, but yeah.
So whole life is archaic.
It's easy to pick on. It's been around forever, and it's boring. And
when it works, find something else. Right.
So go ahead.
Well, let me add this. I want to add into the HELOC, in the list of 8 or 9 topics, because that's come up a lot in the big wide world. Right. But then ultimately we're gonna wind up. I might not deserve a number, but we're gonna get into who talks about all of this in the big wide world, who prints, in Google articles and blogs and videos and YouTube and podcasts. Who's really talking about all of this, and what is their kind of perspective? Not that I want to beat anybody up in particular, but when I go out into the big wide world and you see these things that come up in social media, I walk away with thinking that, oh my gosh, that brings no clarity.
Well, and I'll tell you that look, I'm not the oldest person in the business, right? Not the youngest.
No.
Might be close, but I'm not the oldest. And I am just continually surprised, genuinely surprised at the level of the conversation that you see online, on YouTube, on all the various forums that you mentioned. Things that, to me, it's for each one of these, I think there's a simple conceptual way the appropriate way to frame things, to appropriately classify things, that instantly clears things up. Right.
Well, man, let's
And
get
then it's
to it.
like,
We
wow,
don't even
the
need
whole-
a series to talk about all these.
We really could.
Yeah.
We could go down the list, but and we will. But it just, I really do feel for people, because like, really, this is the state of things. This is
Yeah.
in like the oldest industry out there. This is the state of things. Like, oh my.
Second oldest industry,
Yeah.
I want to say. Okay.
So universal life. Okay, my problem with universal life is that it exposes your capital to exponentially rising cost of insurance.
Yeah, by design.
Period.
You can't fix that. But all right, let's talk about that for a minute. Look, so the problem with universal life, one of them, there's many. We won't cover them all today. Let's look at universal life. Where did the whole idea of universal life come from? In the early 80s, right?
E.F.
Interest
Hutton.
rates. Yeah, E.F. Hutton. Remember him? E.F. Hutton speaks. Everyone listens. All right. E.F. Hutton. Who is he with? Anyway, it was a big brokerage house. So interest rates are going like crazy up in the 80s. And you have Ralph Nader on the scene, you know, the champion of the consumer, consumer protection idea. And here interest rates are going up, and you know, you can get 12, 14% on CDs, 30-year bonds. I remember way back in the day, I ran into a gentleman, he still had 30-year bonds that were paying 12%.
Wow.
So this was like in the 90s, and they weren't, I don't know why they weren't callable, but
Right.
he rode that thing out the whole 30 years. I mean, okay, so interest rates are going up, and you have Ralph Nader and, you know, protecting the consumers, and then you have A.L. Williams and Wall Street colluding with the
Term providers.
Senate
Yeah.
to beat up single premium whole life.
Mm-hmm.
You know, and we've talked about that, and the argument was that it was a loophole for the rich, this idea of life insurance, single premium life insurance. People are putting $200,000 in. Next year it's, you know, worth $220,000, and they're canceling their policy, and it was tax-free growth. And so, yeah, all the rich people were doing that, right? So we got to shut that down. But my point is this: interest rates were going up. You have Ralph Nader, you know, beating up whole life insurance. You have A.L. Williams, the term promoters, and beating up life insurance. And so here the life insurance industry is like on the ropes, and they're like, oh my gosh, what do we do? Well, here, let's create a new product. You know, and we can sell it to all the brokers like E.F. Hutton, and they'll sell it to all their brokerage clients. And what it does, it kind of tries to unbundle life insurance, right? It tries to separate the cost of life insurance with this side account that earns interest. Well, interest rates are very high, so it doesn't take, you know, much imagination just to use a 10, 12% internal rate of return on that side account as a cash accumulation portion of the life insurance, and then you just attach lifetime term onto that. So think about those for a minute. What have interest rates done for the last 40 years? Come straight down, right? Okay, and people are living longer. And so what happens to the life insurance premium, the term life insurance premium? Every year I have a birthday, I'm getting closer and closer to mortality. So the cost, the mortality, the cost of insurance, the mortality charge increases every year. So if you just put that on a graph, right, your life expectancy, you're going to live to 100. Well, hell, what is the cost of life insurance at age 99? Right, pretty dang high, because you're probably dying next year. Right. So my whole point is this: they separated it in a high interest rate environment. This is just universal life, the first version of universal life. You have the high interest rates that you can illustrate as the side account or the accumulation. You know, and 10 or 12% rates of returns on CDs is going to overcome the increasing cost of the death benefit. So they illustrate beautifully in the 80s. Most all of those policies are lapsed, or they paid out. Some people have died, no question. Most of them are
Companies
not enforced.
have gone bankrupt.
And the ones that stayed in force the longest. They've had increased premium requirements.
Yeah.
And, or probably both, decreased death benefits.
Yeah. And curiously, that we see in the blog world that's now part of the pitch, right? It's explained that, look, late into retirement, or if you live too long, we'll have to make some adjustments.
Sure.
Right? We're going to have to increase the out-of-pocket premium, decrease the cash value, or decrease the death benefit, or some combination of the three.
Yeah.
In order to keep the policy in force.
Well, and now in two, I think part of the argument is, we got it wrong the first time. Right.
But it's better now. We figured it out.
Well, we fixed it with, they came out with variable universal life in the 90s, right? Mm-hmm. So they just changed the side account from an interest-bearing account to a sub-account that looks like a mini mutual fund. So if you buy variable universal life, what they're using for the accumulation value, the account value they're called sub-accounts, and they just look like mini mutual funds, right? So they have their management fees and their trading fees in there. Well, tell me, what was the market doing? What was the market doing in the 90s?
It's going great.
Going great.
Up and up, right, until it wasn't.
Well, now a few corrections later, how's the VUL policy looking? All right, the market does not go up forever, right? And the same thing has happened with variable universal life policies, right? The market maybe didn't turn out the way that Life Insurance Illustrated that it would, the returns from the sub-accounts. Cost of insurance has continued to go up every year. That's a fact. Yeah. Right.
Yeah, unavoidable. Right. So there's going to be, if you live, there will be a drain somewhere. Right. And then typically when people, they hide this fact, right? So like we say that the life insurance component of UL is that annually renewable term. And like they do with just regular term, they'll make it a level, they'll have a period of years where there's a level premium payment. Yeah. So if you get a UL illustration, you'll see a level premium payment for 10 or 20 years, right? However long that level period is. Well, then look at the 11th year, the 21st year, right? The year right after it's no longer leveled out, and you see a dramatic increase.
You're talking about term.
I'm talking about the term component of UL.
Oh, okay.
Right? So, because I've seen people send illustrations like this, and we'll say, well, by the time we get out to year 20 or whatever it is, we'll use some of the cash value. We know that we'll have to maybe give up some of the death benefit if we want to keep the cash value. So we start equivocating and making excuses out here for a real problem, right?
Oh yeah.
So whereas with whole life, you're either paying in a fixed or decreasing amount, right? You'd want to either pay your maximum premium for as long as you can, and eventually you'll have to reduce the premium to comply with MEC limits and all of that, right? So you're either putting in a fixed amount or less, whereas with universal life, you're putting in a fixed amount or more in order to maintain the policy. And whereas with whole life, you're continually gaining benefit, with universal life, you're continually forfeiting benefit.
Well,
and it's like, so why would... I don't. It's so clear. I don't understand why that's
so clear. Well, look, the universal life policies that came out. I mean, I say they came out. They very popular in the 90s. The VUL, and so now they've probably been out. The equity index universal life. They've dropped the E. Now it's just indexed universal life IUL. They have it right now. Think about that. They got it wrong the first time. Strike one with universal life. They got it wrong again with variable universal life. Strike two. And I'm just telling you, they've got it wrong now with index universal life. Strike three. Yep. But if we continue, the cost of the insurance that is going to go up every year that you're alive, right? That is on an exponential curve. So the longer you live and the further out you go, there's going to take more premium to keep the death benefit in force.
Wait, there's no caps or floors on the cost side of it?
Hold on. That's before we get there. So your account value, right, which is what it accurately is termed, your account value in a universal life policy on the good years, right, there may not be a problem. In the good years, in the early good years, there may not be a problem. But in the latter years, you need to have a pretty high consistent rate of return just to overcome the increasing costs of
just
the
to
insurance.
break even.
Yeah.
Setting aside even the idea of using the cash value for something like passive income or supplemental income.
Yeah, and that's another. When you get into the illustrations, they always illustrate this miraculous outcome of premium, that's beautiful and affordable, and the accumulation value continues to go up. But then sometimes you'll also see them illustrate, which, let me back up, I don't think it's going to happen. All right, in that beautiful illustration where the premium is consistent and forever, and the account value continues to go up. I don't think that's going to happen.
Yeah, no.
But then quite often you see income illustrations, right? In addition to the account value always going up and the premium always remaining level or diminishing, it shows throwing off an income. And that ain't going to happen either.
Yeah.
And for both of those to happen at the same
Where's
time.
that money coming from? Yeah.
Well, it's coming from an illustration, man. The numbers on the page. All right, so the IUL. Let's look at the IUL for a moment. So, okay, then the life insurance and to me, the life insurance industries are just trying to compete with Wall Street. They're creating these products to be attractive in the marketplace, right? Which is almost like a weak defense. You need to wake up and figure out who you are, life insurance company, and do what you do, right? And do it well. Okay. The Index Universal Life. So now they come out with the Index Universal Life, and they say, well, listen, we won't go into the market. Your account value won't actually be in the market, but we'll use the side funds, the indices, various indices, S&P 500, whatever, and they create their own indices. Goldman Sachs, all the big banks have created their own industry, their own indices. All right, and then they put caps and floors, minimum and maximum, right? Which that's nothing new. It comes from, options have been around a long time, but like the indexed, the fixed indexed annuities, they've been out and they've used that a long time. And so I'm just saying now that we put caps on the upper potential of earnings in a given year based on indices, but then we put a floor, a zero. And
so
then
you can't lose money.
You can't lose money. Zero's your hero and all of these things but you can't lose money.
Just don't get any older.
Don't have any birthdays. All right. So let's not worry about all the other contractual provisions and details in there and just focus on that. You can't lose money. And then we'll end it right there. So that should be enough for you, Mr. Prospect. You can't lose money here. And you can earn 10, 12, 14% interest over here without losing money.
Madoff numbers. Bernie Madoff numbers.
Oh, my gosh.
1% a month.
All right, so you want to talk about the caps and the floors, which that can be complicated. It's not really complicated, but it could appear to be complicated.
No, I think that's good. I think
well, let's.
I don't know what all the hubbub. I don't know. It just amazes me that there's so many people out there pushing it as hard as they push it. It's like, maybe we should sit down and debate one of these people or something. If anybody was ever open to that kind of thing in this business, which I doubt, but I don't. For the purposes of infinite banking, I don't see how it even enters into the discussion. And even for people who aren't into infinite banking, maybe they're in that investment paradigm. They did the Dave Ramsey stuff. They read Money Magazine and all these kinds of things. Adopted the conventional mainstream line of financial thinking. Even for those people, I don't know why you'd want to. To me, it's like never a good idea. You should always play to your strengths. If you're into the investment paradigm, okay, well, go play in the stock market or something.
Sure. Here
you have this product that attempts to have the best of both worlds. Like, we want to be an investment product and we want to be life insurance. It's like we're going to fail on both. I just don't get it. I really just don't.
Well, that's a very old argument against like BUL and UL and IUL from the investment perspective, the investment advisor's perspective. Yeah. They're like, why are you combining life insurance with an investment? And you're exactly right. You're going to fail at both, or you're not going to do as well as you could have.
What's so great about life insurance, such that they can give you a 0% floor and some positive cap, right? They can guarantee you growth every year in the market only because it's life insurance. Like, is there something magical about the addition of life insurance? Of course not. In fact, all there is regularly rising cost. So it's just, and we didn't even talk about loan provisions. I mean, now the value of the collateral is uncertain, right? Or we could at least say the value of the collateral is certain to diminish over time as you get older and older, right? Eventually, that exponentially rising mortality cost will outpace whatever kind of growth you have in the cash value.
No question.
Right? Assume for however long you want to live. So you're going to reach that point eventually, okay? Well, so now we're collateralizing an asset with that over time, the value of which is guaranteed to fall.
Yeah, it's just going to lapse sooner.
I mean, how could that loan be any more favorable than a policy loan and dividend paying whole life where the value of the collateral is guaranteed? It can't be. It conceptually, logically cannot be.
I want to say too that I've heard, clients bring up, UL, different things at different times, but specifically when you hear the word corridor, there has to be a corridor between the cash value and the death benefit, and that's a universal life term, right? And so as the cost of insurance continues to rise and you illustrate these products out into the future, you'll typically see the death benefit decreasing. So it's flattening the corridor between the death benefit and the cash value, right? And you have to do that to be able to illustrate an income, right? So I'm just saying there's, when it comes to illustrations on universal life policies, and I'm specifically talking about IUL, the National Association of Insurance Commissioners came out a couple of years ago and limited the average rate of return that you could illustrate on a life insurance policy.
Gosh, why would they have to do that?
Why would they have to do that? Prior to, I think they capped it at 6%, I believe. Don't hold me to that. Well, prior to that, you'd see universal life illustrations ran at 8, 9, 10 all day long.
Yeah.
8, 9, or 10% illustrated rate of return for the next humpteen 30, 35 years. Really? Okay.
Madoff numbers.
And now, so since the NAIC limited on the rate of return that a life insurance company could illustrate on an IUL policy, they've come out with these multipliers.
Yes.
All right.
To get around it.
So now they can, using multipliers, they can illustrate a higher average annual return. Yeah. And now the NAIC is looking at that, and they might correct that.
So always new additions to work around. Right?
Yeah.
We want to illustrate unlikely market performance over the course of this individual's lifetime, and either it's going to be through high assumed interest rates or with these additional riders that these multipliers. One way or the other, we're gonna show a nice illustration so that we can sell from the illustration. Yeah, that's really the point.
And two, you said earlier, can you bank with universal life? Can you practice the infinite banking concept with that? And you kind of went off into concerning IBC, but if we back up and just look at life insurance, right, before we move off of IUL, the very structure of universal life is flawed because of the increasing cost of insurance. Now think about that. You take a flawed product, and I'm saying this, and listen, I'm not saying anything I haven't said in the home office of every life insurance company I've been invited to. All right? I'm in rooms full of them. It's flawed by design. Well, tell me, young man, how do you correct that? Tell me what a farmer would do if a farmer had a two-headed calf. That's flawed. I'm not saying God flawed that design. There's something in nature that caused that to happen. Well, how do you correct that? what can the farmer do to correct that? Or the dairyman, You can't correct it. So the most merciful thing that he could do is put the animal out of its misery.
Yeah.
I mean, and the point applies. This is flawed at design. By design, it's flawed.
Yeah.
How do you correct that? And my point is, you can't correct it. So what do? You put it out of its misery as soon as possible. As soon as it makes sense. I'm not encouraging anyone to do anything but educate yourself. And you should educate yourself on these talking points before you decide to put money in life insurance of any kind. Mm-hmm. My opinion.
No, I agree. If you're someone who is practicing infinite banking, it's good to understand why universal life and its various other forms don't work or are not proper for infinite banking. And like you say, even outside of the infinite banking context, that they're flawed by design.
They are. All right. So are you trying to beat up universal life just because you don't like it? Or, you feeling defensive out there, reading stuff, seeing stuff on, talking to prospective clients? I mean,
we talked about this earlier, that it's easy, that it seems like there's a lot of people online who accuse people in the infinite banking world, people who like whole life, of just being product partisans.
Kool-Aid drinkers.
Yeah,
we drink the Kool-Aid.
We're married to the product, and
right.
We're just got the blinders on. We're ignorant of other products. We need more designations. We need more professional industry designations to fill the width of the page, so that we have the proper authority granted from other flawed human beings to understand this product, right?
All right, so
kind of want to beat it up a little bit.
Listen, man, if you want to own universal life and hope that it works out, perfect. Yeah. If you want a death benefit that's payable at natural mortality, term isn't going to provide that, and universal life is not going to provide the numbers that you think it or it illustrates. The only thing that's going to provide a guaranteed death benefit at natural mortality is a whole life policy that has the premiums have been paid.
Well, and let's nail this too, because it's often the people who talk about universal life online always implicitly present the discussion in like an either or fashion. So typically a universal life promoter nowadays, now that they've had 40 years to see the disastrous track record of universal life.
Oh, now wait a minute. That presumes that they're 40 years old, and that presumes that they've had 40 years in the life insurance industry, or that they've even paid attention to the history of life insurance.
True, all true.
Oh, wait, I knocked every one of those off.
All right, so assuming all of that, which
didn't happen,
is generous, right? So we'll assume all that anyway.
Okay. Angelic intentions.
Right, assume angelic intentions, always. So they get through all of that, and they say, well, if your desired goal is to accumulate early cash value and not to build up a substantial death benefit, then something like a universal life could be for you, right? So the idea is that the different components that we come across in the discussion of life insurance, those are mutually exclusive. So if you want this, then you should go with this product. If you want that, you should go with a different product, right? And I find a lot of times that this sinks into people's thinking, where they're like, well, if I wanted a high rate of return, then I would do something other than IBC, or I would buy something other than dividend-paying whole life. It's like, no.
I would too.
This isn't the case, right? It's not about, we want to put certain characteristics, certain qualities above others. We have certain priorities, so we're going to choose one product over the other. No. All boxes are checked, right? It's not a this or that thing with IBC and dividend-paying whole life, right? This isn't about this or that. It's not about another segment or component of your overall portfolio. That's not what we're talking about here. At the end of the day, that portfolio, whatever it is going to generate income, which is going to go to somebody's bank. And either you're the owner of that bank or you're not. That's the discussion, right? So it's not a this or that thing. And
not at all. Yeah.
We don't, when we talk about IBC or whole life, we don't have that same presumption, that same initial framework where we say, oh, well, we're going to do an IBC policy design to get you early cash value, but we have to give up death benefit later on. No, you're going to end up with more death benefit than you ever would have got in the first place, right? So it's like, and conversely, it's not the opposite. We're not focusing on the death benefit at the expense of, say, the cash value or the dividend or flexibility in the premium. There's another thing. We don't have to give up flexibility in the premium. No, it's not the case that premium and dividend paying whole life is rigid. Maybe it is if you don't know how to design life insurance. Maybe that's who these people have talked to before. But if you know proper dividend paying whole life, IBC style design, then there's as much or more flexibility than there is in universal life. Because you're not intentionally, purposefully giving up the things that you would value, like the cash account, like the equity that you would build with dividend-paying whole life. So I think people, when they start to, reason I'm bringing this up is that when people start to engage with the comments and the opinions online from the alleged experts with their page width of industry designations, I think even the writers of those things don't realize the framework they're coming into it with. They're so stuck in that investment style paradigm that they don't even realize that the initial assumptions are different, right? We're not in a mutually exclusive world. This isn't about rates of return versus death benefit versus whatever sort of equity you might build. It's and, right? So I just...
You feel better?
I feel a lot better. Okay. Thanks for letting me share.
Well, listen, before we move off of IUL, you've got to look at or just think about, consider this, right? With whole life insurance, you have what are called non-forfeiture options, right? These are guarantees that only exist in permanent whole life insurance. They do not exist in universal life. All right. And so there's several non-forfeiture options, and we'll probably get into that later. I'm just saying that you give up, I don't even know what guarantee you retain with universal life. Tell me what guarantee you even retain with universal life, other than you can't go below zero on an indexed return in a given year. That's a guarantee. So if the indice that you've allocated your account value to loses, let's say it's like the S&P 500 index, and the S&P 500 index actually lost 10% in a given year, you're contractually guaranteed that you will not earn any interest in that index that given year. And there will be no loss in that index. They won't come to you and say, hey, the S&P was down 10%, so you're going to have to give up 10% of your account value. All right, so the guarantee of zero on an annual basis on the earning, that's on the growth side. On the growth, right there, that's the guarantee that if the indices are down, you won't earn any interest. It's a zero. Yeah. That's a guarantee. What other guarantees does a universal life policy give to the owner? What other guarantees does the owner have or retain with a universal life contract? Go.
They're guaranteed to bear the cost of the rising mortality expense.
No question.
Yeah. And then there might be, I've seen some where there is a guaranteed minimum death benefit, right? So after they drain the cash value dry, right, and after the premium's been hiked, right, if the premium still continues to be paid, then there will be some minimum.
And don't leave that out,
but
because
you have to pay the premium, otherwise it lapses. There is no non-forfeiture.
The guarantee IUL, the guarantee UL, which is a big deal, in the industry, solving for death benefit. You want the no lapse guaranteed product. Right. Well, that no lapse guaranteed products comes with that minimum guaranteed premium that you have to pay. If you don't pay the premium, you don't retain that guarantee. Right. Which I'm not saying good, bad, or indifferent. That's just the way it is.
And you paid the cost for that rider the whole time.
Yes, you did.
As well.
You paid for the consumer pays for everything, right? Okay, so what other rights? We have a no lapse guarantee if you want to purchase it. We have the minimum zero crediting if an index is negative in a given crediting period. Okay. What else?
Guaranteed rising costs.
Guaranteed rising costs.
Yep. Jeez.
Yeah, I'm all in. Let me throw hundreds of thousands of dollars into that. Yeah. Okay. And then, so I'm just saying that that you don't even have the guarantees that should come with a life insurance. And I say should. I'm just saying that the whole idea, the very nature, the spirit, the principle of insurance is I want to offset the risk, and I'm going to pay for that to someone else.
Yeah.
There's a 100% chance that I'm going to die. We're all going to die. Okay.
Mm-hmm.
I don't want to die too soon. Right. And I want to cover that risk by paying you, life insurance company, a premium. And that if I die too soon or sooner than I expect, the death benefit's going to take care of my family and all the people that I love. Mm-hmm. Right. So I'm offsetting that risk of early mortality. Now, look, if we go, let's look at the car. All right. We all have to have automobile insurance. You know, I'm a good driver. I don't have wrecks. But in case I do, I'm going to offset the risk by having automobile insurance. So if I do have a wreck, the insurance company is going to come in there and make everybody whole. Fire insurance, home insurance. Mm-hmm. All right, I'm offsetting the risk. That's the nature. That's the essence of insurance.
Right.
All right. With universal life, I retain that risk.
Violating the principle of insurance.
Violating the very spirit of insurance.
Yeah.
I mean, well, James, what do you mean by that? Okay, well, if I don't pay a premium or I have to lower my premium, right, which could happen, even if I didn't lower my premium, if I continued to pay my premium, I'm still retaining the risk that death benefit is going to be enforced because if that cost of insurance out increases my premium and my account value, the death benefit's going to go away. Mm-hmm. I'm like, oh my gosh, how profitable can that be for a life insurance company? You pay us for a risk that we're going to let you retain.
That's exactly right.
It's terrible. And if you can't think through that, you know, or you get lost with illustrations and great big magical presentations, you should keep reading.
Yeah.
You should keep learning.
This is one of the very many reasons, the very, very many reasons why I say that, you know, the illustration is really beside the point. You know, there are much more significant. If people weren't so obsessed with illustrations and spent that energy focusing on the concepts behind these products, behind these sales pitches, right, then we'd all saved ourselves a lot of time. Because I think we get hung up on the fancy illustrations. Oh, you know how nice it looks, and it's going to last for so long.
You're going to prevent a lot of disappointment too.
It just right.
Yeah, I'm with you. We just traveled. We drove to Colorado from Texas. You know, I love a map. I want to know where I'm going. I want to have an idea of where I'm going to wind up if I take off. Mm-hmm. But you know, the whole trip was, I don't know, 9 or 10 hours. The scenery was awesome.
Yeah, really awesome.
The conversation was awesome. The company was great. Man, I did not live or die by that map on that trip. The same thing. I want an illustration. Give me an idea of where we're going and what's possible. Let me know how to work this and how to own it and master it, this product, this asset of life insurance. And then let me enjoy the trip. Let me go do what I'm going to do anyway. Mm-hmm. Kind of the same thing. I want an illustration, but I'm not going to live or die by that illustration.
Right.
But I do know how to make an illustration or a policy perform better than it's illustrated.
Yeah. And you should know if that map tells you can get
my
the car.
clients do too. I'm just saying.
And you should know if a map were to show you that you can get from Texas to Colorado by car in, say, 5 hours rather than the 9 it really took, well, then you should probably throw the map away.
Something's wrong.
Yeah, right? Should probably get a map that illustrates reality rather than fictional assumptions.
I tell you what, looking at some of these illustrations, and I don't ask for illustrations. You know, I mean, people send me illustrations. Probably you too. I know they do. Regularly. It's like, James, this is what I'm doing. I don't think it's right. And your suspicions are probably correct. Looking at some of these illustrations lately over the last several months, it's like, my gosh, this looks like an investment pro forma. This looks like somebody's trying to get you to invest in some blue sky here. But the consumer or the investor and when I talk about a pro forma, it's like they don't even know what they're looking at.
They really don't know. Yeah. That's
So
really the issue.
Then the encouragement is for you to make a decision based on a bunch of numbers on a page.
In a state of confusion.
Oh my God. And and there's nothing right about that.
Yeah.
There's nothing right about that. I don't care who
confusion.
you are.
The more confused you are, the less questions people are likely to ask. Especially because they feel intimidated.
Okay.
Well, let me say this one last thing. One thing I have seen on the Universal Life people is they'll say that, promoters of whole life will add a term rider, which is fair. We do that. And
sometimes
that's an admission that we're trying to make whole life look like universal life. Right? Because we're adding a term.
Did you see that somewhere?
Yeah.
Oh my gosh.
In the article that
don't name names. I
showed you. Yeah.
Can't even read that one.
Yeah.
But I will, maybe.
Of course, so the key difference being, you have a right to drop that term rider, right? Because the idea is, if you add a term rider and you keep it on forever, well, then you're going to have the same internally rising cost of insurance too. And it's like, yeah, that's true, except when you don't. Except when you get rid of it.
You mean it was a 10 or 20-year term rider and it was meant for 10 or 20 years?
Yeah. So I just want to say, that doesn't make any sense either. No, we're not trying to doing whole life the way that people in the infinite banking world might do it. Say if you did happen to use a term rider, which by the way is not necessary, but if you happen to do it that way, it is not the case that we're trying to pretend to be universal life.
So are you saying bloggers are like bloggers I don't want to give them too much credit, these promoters of these products and in social media, they're like telling when it comes to the infinite banking or the whole life type person who's drank the Kool-Aid and who's short-sighted, can't see past the company, or am I hearing you correctly saying as you read those articles, they're presenting our opinions and presentation or our opinion of life insurance in general. So they're telling the reader, the listener, what we think or intend, and then they're pointing out what's wrong with that.
Right. Yeah. Yeah. It's called straw manning.
That's a fake argument for a fake preconceived solution.
Yeah, to validate their
opinion.
Look, they're well intended and everything.
Angelic intentions.
Yeah, but they should be careful. The problem again is that there's no economic foundation to guide why they would want to do this or that thing.
Yeah, that's
how they end up trying to play in both the investment and the life insurance sandbox.
It seems to me like and it kind of I see these lists, the like the top 10 companies to practice infinite banking with, and you're reading the list and you're thinking, that must be who they're appointed with, because none of those companies should be in the top 20. You know what I mean? But it's presented out there and it lives forever online, so it must be true. Anyway, I'll save it for more in depth on universal life sales, gimmicking, marketing, product pushing, fairy dust, smoke and mirrors, and you see it out there in the big wide world. But I'm starting to see it creep into the infinite banking footprint in the in the world, and it's like, why? Just stop it. Just quit it. Just stop. Right? That's all.
Just don't do that.
Okay.
I covered it. I covered what I want to say about UL.
I'm leaving a point or two off, but I can't recall what they were. But the bottom line is, in my opinion, from what I see, the owner retains all of the risk. And there are next to no guarantees in a universal life contract. And I think the life insurance company should stiffen their backbone, right, and recognize who they are and embrace who they are and deliver the products that they have and they're capable of delivering, and they've delivered over the last couple of 100 years. And then two, if I go back to what you mentioned pretty early on, is, when you get down to the fundamentals, the very basics, and you can properly classify things, a lot of this stuff goes out the window.
It really
if
should.
You just consider the basics, the fundamental basics. Okay.
All right.
I hope that was helpful.
Yeah. Thanks for listening. Talk to you next time.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe. Otherwise, find us wherever you get your podcasts and subscribe to join us weekly.